Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about two brand new covered call ETFs that come to us from Goldman Sachs. They are GPIX GPIQ. One is about the S&P 500, one is about the NASDAQ 100. Can you guess which one is which? I bet you can. But anyway, these covered call ETFs, they just keep coming at us, and we're trying to cover them all and see if some of these might be right for us. As I've said before, they're not always right for everyone. So we're covering the basics with these two today. They are brand new. So if that is what you're looking for, please stick around. Whoop. So recently, we have been talking about a lot of different covered call ETFs. And I like to preface these conversations by saying these products aren't right for everyone. So make sure you have a use case of why you want to have this in your portfolio. In my last video, we covered why buying something like a VOO, an S&P 500 index ETF, or just a QQQ, something like that, something based on the NASDAQ, might be a better option for you. In most instances, for most investors, I think that is the better option. But in some situations, these can fit well into your portfolio. So that's what this should be aimed at. So as you're going through this, if you're watching this, think about it. Is this the right product for me? Okay, so let's look at these side by side. So we have GPIX and we have GPIQ. Similar to the setup for JEPI and JEPQ from JP Morgan, if you're familiar with those products. Same thing here. So with the X, we get the S&P 500 Core Premium Income ETF. So it's got those 500 stocks and the options that they're trying to utilize to add additional income. Whereas if we jump over and we look at the Q, we're going to see this is based on the NASDAQ 100. It'll have those 100 stocks in there. And then that option overlay to generate that additional income. So focusing on the X here, we see that this has only been around since 10/24 of 23. Hasn't been around that long, but it's been in this nice rising market. So we should expect pretty decent performance since inception, and we'll take a look at that here in a little bit. Now it's got $30 million in net assets, so it's a slow grower. It's growing, it's coming on, right? 30 million. If we look at GPIQ, that's market price. Where's net assets? 25 million. So lagging just a little bit behind GPIX. So what is this all about? Well, it's similar to the other ones, right? It's going to see consistent monthly income, aims to generate a consistent, that's important, monthly distribution rate, generally from options, premium, and equity dividends. So the dividends from naturally owning those stocks, the option premiums from selling these call options, and consistent is an important word because with JEPI and JEPQ, we do not have consistency. You have 30 cents one month, 50 cents the next month. It can be all over the board. In this case, they're going to try to hold that more consistent, and that might affect the NAV a little bit. It might affect how this performs a little bit within your portfolio, right? So just something to be aware of. So core equity exposure with lower volatility potential provides core equity exposure to the S&P 500 index and dynamically sells call options, allowing for participation with rising markets and potential outperformance in negative to flat markets. Okay, so they're going to utilize options to generate income. In sideways to downward markets, we know that can help us out. It gives us that income, right? But in a rising market, the only way to capture some of that upside is to sell out of the money calls. And from what I can tell, they don't do that. They sell at the money. But what they do is they vary the amount. So if this portfolio with net assets of 30 million, they might sell 10 or $15 million worth of options against that, okay, to expose half of their portfolio, I should say. And in that case, half the portfolio can take off, right? And those options can either perform well and put option and premium in your pocket, or you can pay a little bit to close them down, but you still get some equity participation here because you're not fully exposed. So that's how they have a control valve there that they're using. We'll take a look at that as well in a chart and see how that might play out versus selling just out of the money. All right. And diversifying source of yield seeks to deliver attractive yield with a lower correlation to traditional income sources and their risks. Again, this is one way to not correlate everything with the stock market, right? So if you're not all in VOO, but you maybe have some combination of that with this, maybe that works better for you and your age and what you're trying to accomplish in your world. Okay, so all this holds true also for GPIQ. Everything's the same. And if we scroll down, we're going to see a similar net expense ratio as well. That's one other thing worth pointing out is this is very attractive for a covered call ETF, 0.29 or 29 basis points. So not a lot. That's $29 per $10,000 invested. It's not nearly as good as just buying the S&P 500 index in an index ETF. But in the covered call space, this is really attractive, right? This is actually a little bit better than JEPI and JEPQ, which is very good. And if you look at some of the other ones that we talk about, it can be 2 or 3 times this rate. Okay, so 0.29 is very good in the covered call space. And this is a download of all the holdings for GPIQ just to get an idea of what's in the fund. And I'm not going to be that surprised because it is the NASDAQ 100. So if we look for Apple, we should see a sizable holding of Apple. In this case, 8.47% of the weighting in this particular fund. If we scroll down, we can find other large ones like Microsoft at 8.73. We can find Meta that had great earnings today at 4.07 and growing. Good job, Meta Platforms. And if we scroll down to the bottom, we're going to find these call options. So down here, they just entered their new order for the month. And let's see, the expiration is going to be the end of February. Okay, so 2/29 of 24. And these are flex euro style options. All right, don't worry about flex. Flex is just what it sounds like. It's a flexible option they can work out with all the details that they want in these call options. In this case, they've got 221. So we can run some simple math and we can see what they're doing here, because that is the current at the market price. They opened it up at around 417. If we do multiplication, fancy math, we see that that gives us coverage of about $9.2 million against their fund. That's about $25 million, or about 37% of the fund. So they're not selling 100% at the money. They're selling, in this case, this month, 37% at the money, and they're letting the rest of it rise. So in a bull market, they're going to sell less call options, and in a bearish market, they're going to, or a sideways market, they're going to sell more at the money calls. That's the idea, and that's spelled out in the prospectus, and we can look at that right now. And welcome to Reading the Prospectus Time with Dave. It's always fun to read a prospectus. Now, principal investment strategies, and we go down to generate income. The fund employs a dynamic options override strategy whereby the fund sells call options on a varying percentage of the market value of the equity investments in the fund's portfolio. The override level is generally revised each month, and the fund expects that under normal circumstances it will sell call options in an amount that is between 25 and 75% of the value of the equity investments in the fund's portfolio. All right, so the fund generally expects to sell call options on blah, 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 on benchmarks. Okay, so in this case, it was QQQ. We saw that. So is this starting to make sense? Right, so you have two different options, and we'll take a look at a chart here in a second. You can sell out of the money, and I prefer to do that. But if you are going to sell at the money, you don't have to sell against your whole portfolio. You can vary that amount. That's something that SPYI, also another one that we've talked about, has in their utility belt to use when they want to. But this one kind of focuses on that point. So how can that affect things? Well, let's take a look at a chart real quick and plot this out and see if we can understand how it would affect our portfolio doing it this way versus selling out of the money. So here's my chart that I came up with to explain how this one's just a little bit different than some of the other ones that we've talked about. So let's suppose you have 200 shares of SPY and you just want to own those over the next 30 days. Well, that represents this gray line. It's linear, right? If the stock doesn't perform well this month and it drops down to 475, and by the way, when I did this, it was at 483. So at the end of the month, if it drops down to 475, you end up having $95,000. But if it goes all the way up to 515, you have $103,000. It's linear, right? That's what we're doing. We just own the stock. But we have other options with options. And the second one is kind of what they're doing with this fund, right? This is the blue line. This is when they sell half their shares, in this case, at the money, at that 483 strike price, and they collect a premium. In this case, it's about $800. It's a pretty good premium that you're collecting because you're selling at the money, but you're only doing it on half your shares. That's the blue line. It's covered by the orange line until we get to this point, which is at 483, right? At 483, which is our strike price, we're no longer a full participant in the stock rising. We're only a half participant. Half the shares are covered and half the shares they get to run. So if it's a bullish market, or if they're expecting a bullish market, it's always kind of a guess, right? Then they're going to sell a lesser amount against those positions. Otherwise, they're going to sell more calls if they think it's more of a bearish market. In that case, we get to participate in half those shares, and that's why we get this linear blue line that continues to grow at a rate. So how high do we go over the next 30 days is the question. Now, the orange line is what we typically see in a lot of covered call ETFs. In this case, we can get that same premium by selling 1.7% out of the money at a strike price of $491, and that's what the orange line shows here. So in this case, we're selling out of the money all the way up to $491. We get to be a full participant. We get to collect all that $800 of glorious premium and the stock rising. But when we get to $491, we're no longer a participant at all. Go completely sideways. We are lame. So how high did we go? And we can see that point where it crosses here, right around, let's see, I think I click on here, it's going to be 499 in this case for this set of data. So you can see different ways to attack the same problem and give you a different control valve and result. And that's what they're doing here. They're going to say this month I'm going to do 30%, next month 60%, following month 50%. We'll see. We don't have a lot of data on it yet, but that's the idea. All right, enough of that boring options talk, but I do think it's important to understand how the mechanics work in these particular funds. So now let's jump over to Seeking Alpha. I am a Seeking Alpha affiliate. There's affiliate links down below if you like what you see. Again, if it's right for you. But I do a lot of my research here on Seeking Alpha, and they're offering some good deals of late. Now, these two particular funds only go up and to the right, which is glorious. So you should buy them. I'm joking, of course. The inception date is late October, and since the beginning of November, we have been on a nice run. Hopefully you were invested and you did well yourself. But yeah, it's had good performance thus far based upon this limited amount of data. And same thing with GPIQ. Now we can jump over to the dividends, and we can look at the dividend history here, and we're going to see we've only had a couple months posted so far. So we had 38 cents and 39 cents, and I want to say it's 30 cents and 31 cents for GPIX. So about the same, but you know, there's always going to be more volatility in the NASDAQ than you're going to find in the S&P 500. So that one, if you annualized it, GPIX is just over 8%, 8 to 8.25 right now, based off of 2. So we have more coming. And this one would be closer to 10% with this 38 and 39 cents. So decent amount of yield. I know lots of people looking for that yield. That shouldn't be your underlying reason for buying. It's really important not to be driven by that. But yeah, pretty impressive yield spun off from these two. So that's my quick review of GPIX and GPIQ, two brand new ETFs from Goldman Sachs. Now, I do love the fact that the expense ratio is so low. That's great. Creates competition. Maybe we can drive those expense ratios down even more because I don't like the expenses. But let me know what you think about these two. Is this a watch? Is this a no, I don't want to touch it? Or is this a too late, Dave? I already bought it. Let me know what you think about these two. Now, I got to start focusing on Las Vegas. I go to Las Vegas every year for the Super Bowl. Okay, so last year I bet on the Eagles. Then they lost, and I had this ready. So I looked like a winner anyway. I was rolling with my homies. So I was thinking I could go with this again this year. But I'm kind of getting sick of Patrick Mahomes and his beer belly, and Travis Kelce's annoying with Tay-Tay, all that crap. So I'm going 49ers, and this is the one I got for this year. You got to get a t-shirt every year. And now I got them both covered. I'm going to look like a winner. You just switch it out as soon as the game's over. And when you're in Vegas, that matters. I'll be at the blackjack table anyway. But here, this one is Big Chicken Brock. That's for Brock Purdy. It's probably not a chicken. It's probably a Big Rooster Brock. All right. Who am I fooling? Anyway, it's going to be a lot of fun. Come see me in Las Vegas. Super Bowl. It's going to be wild and crazy because that's where the Super Bowl is. So we're going to see what happens out there. Anyway, any comments on these two or about the Super Bowl and who you like, let me know. And I really appreciate you watching. Have a great night. Take care. We'll see you next time. Whoop.